Good morning, everybody, and thank you for joining us today. Hope you've all had a really good summer break and ready for an interesting next 6 months. For those that don't know me, my name is Philip Thompson. I'm Regional Director for Deepbridge Capital for Central England. Appreciate everybody's busy, so we will be sort of strict on time today. I know we've got a lot of IFAs and paraplanners on this session. There's a lot of interest about what we're going to talk about. This is the first one in three over the next 3 Wednesdays. So if you do miss one, there will be a recording available. So please speak to any of my colleagues around the country or head office, to Mike, Donna, Terry or Steve. And of course, we'll support you with whatever you need. So today we shall be focusing on April 2026 and a review of the upcoming business relief changes as they stand prior to anything in the budget, if it changes. Next Wednesday, we're going to be looking at IHT planning in detail, looking at the basics and beyond. And then finally, on the 24th of September, we'll be looking at IHT for the next generation. Along these 3 weeks, I will be joined by various esteemed guests, and each week experts in their field. And today I'm delighted to be joined by, from head office, Andy Aldrich, our Chief Operating Officer. Good morning, Andy.
Morning, Phil.
Good.
Good to see you.
And you. What I'd like to do today, Andy, is 3 things, just to recap and understand the changes coming through. What this means for IHT planning, and thirdly, what are the strategic considerations for IFAs at the moment. So for those of you that know Andy, Andy loves questions, so please use the Q&A function on the screen below, and I'll try and slot them in along the way or at the end. And in particular, we do welcome questions around the role of AIM in client portfolios, whether we see a shift in unquoted BR strategies, and crucially, what support do advisors need to taper your IHT approach. So that's enough from me. So Andy, if we could just kick off, firstly with could you summarise the key changes to biz relief and agricultural property relief announced in the 2024 budget, please?
Of course, good morning, everybody, and apologies for the oversell there from Phil. Anybody who knows me will be disappointed to hear me being described as esteemed. So thanks for that, Phil. But yes, look, I think a lot of the things we'll be going through this morning are kind of a recap and just a refresher, just remind everyone where we sit. Everyone will have remembered the flurry of activity kind of post October 30th last year, and it's just refreshing everyone where everyone needs to be, what they need to be considering when looking at IHT planning and BR in particular. So look, the key changes to business relief that were announced in the October 2024 budget. This is for business relief, or formerly known as business property relief, as well as agricultural relief, which was agricultural property relief previously. And in very simple terms, from 6th of April 2026, there will be a £1 million allowance for individuals, which means that BR and AR will be at a full discount, so will be charged at 0% up to £1 million per person. Anything over £1 million will be charged at a 50% discount on IHT. So rather than being charged at 40% inheritance tax, will be charged at 20%. The other thing, which I'm sure we'll come on to talk to in a while, is around AIM stocks, which won't have that £1 million allowance, so they will be charged at 20% IHT from 0 upwards. So that's in a nutshell. I think the key thing to get across is that these are individual allowances. There is no spousal transferal, etc. These are not for married couples. These are individuals. So again, I think if we talk a bit about kind of what the impact is and what considerations need to be, I think that is one key consideration to be taken, is that these are per person, not per couple, and there's no interspousal connection.
Okay, thank you. And I think it's been interesting since the budget last year. I think every IFA I've spoken to has said, we need to do something about it. We've got to review it. It's not going to affect all of their clients, but for quite a few, it's going to be a change of planning for them. And in some cases, I've had IFAs put off retiring because they want to look after the clients and make sure everything's in place going forward. So it is a big change, and I think one of the key things is not leaving things to the last minute. Let's get the ducks in a row and make sure that everything that we can do is done. To put the clients in the best position. So just to talk about a little bit more about AIM listed shares, how are they going to be treated differently under the rules? If you can just.
Yeah, absolutely, Phil. So, like as I alluded to, there's no £1 million allowance.
Yeah.
So all AIM stocks will be charged at a 20% IHT relief where they BR qualifying. And let's not forget that not all AIM stocks qualify for business relief. So just because you have a portfolio of AIM stocks does not mean that every single holding within that portfolio will be BR qualifying. I think that's a fundamental thing. And again, a few years ago, I was at a presentation, and one of a highly esteemed, I'll use that word correctly this time, a
Thank you.
highly esteemed AIM provider was saying that often up to as much as 15% of any holdings they have at any one time don't qualify for BR, just because until they go through a test, they don't know. So again, that should always be a question when looking at AIM for BR purposes. But going forward, the fundamental from the 6th of April 2026, all AIM, if whether they're all BR qualifying AIM stocks will be charged IHT at 20% rather than 0% currently, but it's still a 50% discount. So again, if you've got AIM stocks and you've got clients with more than £1 million, so going over that £1 million BR allowance, then AIM still has a part to play, most definitely. And I think there are other considerations which we can chat through, but that's the simple thing to remember, that the £1 million BR allowance does not cover AIM stocks.
Okay, and just to follow on with that, are there any transitional rules for lifetime gifts made before April 2026?
Yes. Effectively, any kind of lifetime gifts prior to that, within 7 years, could well discount against the BR limit. So again, it is worth advisors looking back at what gifts there have been within the last 7 years, as that could reduce that £1 million allowance further. So again, it's not just a simple consideration for new clients looking at BR, but certainly looking at individuals that have been utilising BR, whether that be AIM or non-AIM historically. There is that consideration has got to be given as to what's been gifted previously, and what have you. There's various other considerations.
I think it's a very complex area, isn't it? And
Yes.
there's so much to consider. I mean, from a personal point of view, I've had so many people in where I live in my lane that have asked me about what they should do, because it is really hitting home
Mhm.
about the changes that are coming through. And invariably I said, well, you need to get advice. That's the thing. But none of them have advisors. So it's a question of education and reaching out to new clients as well as existing clients for IFAs, because there's a lot to be done, and
Oh,
it's an opportunity.
it's a massive opportunity, Phil. A
Opportunity,
massive
yeah.
opportunity. Yeah, I think, let's face it, business relief and inheritance tax planning has never been as much in the forefront of
Yeah.
mind of individuals as it is now. So if you've got people who have maybe played around with their own investments previously, then now is the time that they need financial advice going forward.
I've recommended a couple of IFAs to my neighbours as well, so we'll see how that works out.
Yeah.
So, I mean, obviously, as we said, big changes. What do they really mean for IFAs going forward on tax planning?
I think that I think the opportunities there. I think just going back to the opportunities, but I think the opportunities are broad in terms of what our advisors need to be looking at. And I think the key thing is, we've certainly, you and I, Phil, spoken to some advisors over the last kind of, approaching 12 months since the last budget, who maybe have been going, oh, we're going to wait and see what happens, or we're going to wait for the outcome of the next kind of review by government, etc., and things like that. And actually, we're now running out of time. It's approaching 6 months until the 6th of April.
Yeah.
So advisors have got work to do. I think just some of the considerations that need to be looked at. We talked about historic gifting and working out where those might impact the BR allowances. There's also the fact that how individuals' wills are written, because these allowances are individual. Then you've got to be looking at these things that you need people to be setting up wills as tenants in common rather than joint tenants, so that you can separate out where entities are going, where beneficiaries are going to be receiving things, and rather than just relying on things to be transferred into spousal. If you have got clients with estates combined more than £1 million, then you want to be using both allowances. You can get up to £2 million. So that will need to be driven by the wills, because if one spouse dies and everything transfers to the second spouse, then their limit is still going to be £1 million. They're not going to have a £2 million allowance. So again, looking at the wills, how those are written, how they're drafted, where the beneficiaries come into play at what stage, is critically important. And again, looking back over historic planning. And one of the other areas to consider is that if you've got clients who have their own businesses and are directors of their own businesses, then what is the BR qualification of those businesses? How's that being treated? Are those companies still qualifying for business relief? Does that need to be considered alongside maybe the items that advisors have advised on previously? And similarly, kind of, I guess, very much at a base level, is that if you have got clients who are in AIM stocks and they have less than £1 million of BR assets in total, or potentially if they have more than £1 million in AIM, then it should certainly be a consideration at least about moving that into non-AIM stocks as you go forward. And I think, and again, the considerations around that, we've seen the volatility of AIM over infinitum, if you like, but certainly over the last 5 years. And if you look at AIM, I think last night when I was looking, 5 years AIM is 20% down. This is AIM all share, so not necessarily individual products. But over 1 year is 2.6% up. So again, depending on when clients went in, will dictate partly whether it is worthwhile in their best interest to move over to new assets or not. And then some of the considerations there are the usual things you'd expect to look at. Fees, what are the fees of exiting? What are the fees of going into a new product? And what does that look like? So again, all these kind of things, these calculations need to be considered as part of an overview to make sure that transferring people is correct. But ultimately, we're biased about our own products, but some really good BR products in the market, which are unquoted assets that have got good steady returns over the last 5 years, etc. That people should be considering. So I think the fundamental is: have you got clients in AIM? Do they need to be moved? Is the value of correct, that it's right to move at this current time, etc. So that's probably the base level. But then beyond that, looking at wills, looking at historic gifting, looking at the interaction with trusts as well. That's another complex area which I know in next week's seminar or webinar rather, you guys will be looking at the wider IHT world. But certainly there is interaction between BR and trusts that needs to be brought in as well. So it's not necessarily a clean and cut thing, but I think the most simplistic terms is that if you have clients in AIM, you've got to be looking at whether it is right to move those.
Yeah, and I think traditionally it's always been quiet over summer, but I think as around the country, we've seen a huge increase in the amount of interest in our BR product and requests for illustrations and further information. So everything is coming to a head. And as you said, don't leave it to the last minute. These things take time. There is a leading time. So sooner we can start talking about it and supporting you guys, then the easier it will be.
And I think, Phil, as well, let's not forget that if you are transferring somebody from AIM stocks to non-AIM BR currently, then replacement relief still applies. So if those shares have been held for more than 2 years, then the transfer from day one, the new shareholdings will or should qualify for business relief from day one at the full 100% discount on IHT. If you leave it beyond the 6th of April next year, our kind of understanding and reading the situation, and this is subject to legislation being confirmed, etc., but it will be done at the BR rate. So if you've held AIM assets, for example, for more than 2 years, and you're transferring after the 6th of April next year, then that 2 year, the next 2 years will be at 50% discount rather than the full IHT discount. So again, getting it done before the 6th of April next year could be important again if you're transferring assets.
Okay, thank you. And also we've got the added complication in 2027 with pensions. How do you see that impacting BR?
A great question. I think we all know that historically in the advice world, we have advisors that have been very proactive and looked at tax efficient investments, such as EIS, VCT, business relief, etc. You've had those advisors who have maybe stayed away from it for whatever reason, whether that just be because of the organization they're in or because of their client base, etc. But no matter where you sit in that kind of that ballpark of advisors, is that tax efficient investments such as BR are now got to be central to thinking. Similarly, other kind of peripheral tax efficient investments around that, such as EIS and VCT, have to be considered for various different purposes. So I think we are going to see an increasing interest and need for these products. Like I said, some of that will be driven by clients.
Yeah,
If clients haven't been advised on BR historically, and they've seen it all over the news over the last 12 months, and certainly as we lead up to the 6th of April next year, then clients will be asking about business relief. Why haven't you invested me in business relief qualifying assets previously, etc. And similarly, the same goes for EIS. We're seeing EIS become more and more common parlance amongst investors and individuals. So advisors are going to be having to look at these things. But in terms of your specific question about the changes to pensions from the 6th of April 2027, so we've got an extra year's grace on this. And of course, there's still consultations going on as to what this will finally look like. But ultimately, the plan is that unused pension pots from the 6th of April 2027 will be subject to IHT. And look, we all know, and quite rightly, historically, a number of advisors have basically just told clients just to keep putting into your pension. That will be your IHT free pot. Don't worry about it. And then we can use other assets to draw an income. And that kind of advice will have to be reviewed and looked at and potentially flipped on its head. And I think, we're going to see the use of BR commonly alongside pensions. So it might be that
yeah,
people in the accumulation stage are investing in pensions as well as BR qualifying assets on an ongoing basis. And it might also mean that people in the decumulation phase are potentially drawing out lump sums to place into BR qualifying assets, and what have you. So there's those kind of conversations. There's then much more complex scenarios where I know you and I have talked about this client in the past, Phil, but we had an advisor conversation about a client who had considerable assets in pension that he'd been told not to touch, but then had a significant buy-to-let portfolio, which is where he was drawing income from. And in reality now, the client needs to start drawing down from the pension to kind of reduce that, and is looking to now sell off that buy-to-let portfolio. So, again, the sell off the buy-to-let portfolio, that will be crystallizing a capital gain. So, they'll probably be using EIS to offset some of that crystallization and that CGT liability, which EIS stocks are BR qualifying. So again, that plays its part, but then can look at more kind of more inverted commas vanilla BR propositions as well alongside that. So I think we are already starting to see that. I think we're seeing a
yeah,
lot of these probably over the summer months and earlier this year have been maybe hypothetical conversations. Whereas over the next 6 months, as we lead up to April, they are going to have to become practical conversations and actually action to make sure these things start happening on an ongoing basis. So, yes, look, BR is going to become more and more important to advisors and to clients, but similarly, ancillary products such as EIS, where it is BR qualifying, but you can utilize it to offset CGT or income tax as well, become even more important to players who are decumulating from other assets.
yeah. And I think actually before we go on, just to say, I think there was a technical issue earlier. So a lot of people have not came on just after we did the review. That's what we've done so far. Just looked at the changes coming through, and then Andy was just going over the implications for IHT planning. So I think we're back on track now. I don't know what the problem was, but I've just been notified of that. So yeah, I mean, over the summer, I mean, a lot of IFAs I've spoken to, they've either said to clients, well, just spend the money, whatever.
Yep.
Great, okay, that's advice, isn't it, of some sort? But a lot are now taking out the tax-free lump sum and putting it into BR, which is more capital preservation. And it is complex depending on age and other factors as well. But it's something you can't rule out if you don't sit down with the clients and have that discussion. Then
Yep.
you doing them a disservice. But it's a difficult time, and we'll see what happens. And we're here to help IFAs and power planners with case studies and advice.
And look, I think, categorically, what we're not saying is that advisors should be rushing out and getting every single penny out of a pension they can and moving it. Pensions are still an extremely important part of tax planning and of financial planning. But what we're saying is that things need to be looked at and considered. And it might be that actually less money going into pensions or more money being drawn down from pensions is a right planning method. But there are tools out there to help advisors and clients plan for such scenarios.
Yeah, absolutely. So one of the things that, again, looking at the conditions for replacement relief and how they apply, is there a compliance issue for that scenario as well that IFAs and power planners need to be aware of?
I think the main thing I think is when revisiting any advice, I think it's important to reflect on why the original advice was given, and client's current situation. So
Yeah,
you might have, for example, compliance might push back on, kind of the risk or liquidity or various different other kind of prospects regarding certain funds or propositions, etc. I think for some advisors, historically, it's been easier to write AIM business because it looks and feels more like a mainstream investment, i.e., there is at least a perception of liquidity, i.e., majority of the time you can request to sell and you can do so. Whether that's true liquidity, given the volatility we've had over the last few years, and whether you're actually going to get, inverted commas, your money back, or whether it's going to be a significant discount is a different matter. But I think, potentially moving from AIM to unquoted BR assets, where often the fund is investing in a single trading company or maybe a couple of trading companies. Again, that's it, which I guess advisors should be talking to their compliance about, just to make sure they are kind of gauging that from a risk liquidity perspective. In reality, are unquoted BR products much higher risk than AIM? No, you should be treating them all as high risk because that is the nature of what these assets are. However, I would suggest having a chat with compliance just to make sure they are happy with why you're doing this. And let's not forget that for a lot of clients, they're utilizing BR because of poor health. They want the 2 year
yeah,
window, etc. So actually, the tax saving can potentially sometimes override the risk profile, etc. But again, that's a conversation to have with compliance to make sure they're happy with it. Speak to the clients as well to make sure they fully understand what they're getting into. And I guess the key thing as well for any kind of estate planning, etc., is where possible also talk to the future beneficiaries. It's a great opportunity for advisors. All these changes are a great opportunity to engage with the next generation, which I know for a lot of advisors is often the challenge that
yeah.
money leaves when people die. Where actually at the moment, living in a high tax environment that we do, the next generation will also be needing tax advice. So this is a great opportunity for advisors to be speaking to future beneficiaries as well.
Yeah, it's a difficult conversation to have, isn't it? But I think the government are doing their best to help everybody out in that respect. But I mean, we know that from a BR point of view, that we can invest the money within a month, but usually within a month, and therefore, that 2 year clock just starts ticking straight away. So in terms of moving money from an AIM portfolio, do you feel there might be a backlog? Because it seems to me, speaking to advisors, getting money from one product to the other always seems to be a hassle. I mean, which is another reason why I don't leave it to the last minute. We see a lot of EIS business written, in the last quarter of the year, and we always accommodate it. Um, but it does cause a problem. It can cause a problem. So again, do you see that being a problem with AIM?
But potentially, I think you've got to look at it in context, and ultimately, there is going to be, to a degree, a rush on AIM BR products. Ultimately, as long as the value has maintained some degree of value, then a lot of advisors will be looking to move from AIM to non-AIM. So the closer you leave it to a deadline, the more of an impact that's likely to have on the market. Now, I'm not predicting the markets. I'm not doing any forecasting. I'm not making any kind of crystal ball claims. But ultimately, if everyone decided to withdraw from AIM and move over to non-AIM, on the 5th of April next year, then that will have a direct impact on valuations. Now, we might see over the next 6 months valuations in AIM continuing to rise as they have done over the last year, in which case, some advisors might be going, well, we're going to wait and see and try and reclaim value. That's understandable. But I think you've got to remember that the more people are claiming to remove BR products from AIM to non-AIM, then that might have a negative impact on the market. So again, timing is important. I would suggest don't leave it all to the last minute. You've got 6 months now to do it, so I think just start planning and start moving things as quickly as possible, where appropriate. I think the other thing to bear in mind is that we're already starting seeing all the conjecture about what might appear in the October budget this year. Well, I think one of the things that advisors
November
can be.
budget. Is it November?
Oh, was it November? Sorry. Anyway, the autumn budget.
Yeah.
The it's now party season for the political parties. So we're starting to hear the conjecture and the testing the water on certain things. And I think everyone is expecting there will be an increase in taxation in potentially different areas. However, obviously BR is something which was changed last year to come in from effect from April next year. So this is one area where advisors can advise in confidence ahead of the budget. Don't wait till after the budget and see what happens. You can get on with doing this BR planning right now. Whereas this time last year, a lot of the conjecture was around BR and inheritance tax, and therefore quite rightly, advisors were kind of waiting and seeing and seeing what's happening. Whereas this year, that's been done. There's other areas which they might need to consider waiting about or seeing what's going to happen, or need to accelerate planning. But BR, we know where the ground is, so crack on with it and just get moving on things. Don't leave everything till Q1 next year.
Yeah, absolutely. And I think I've never seen it in all my time in financial services, the amount of media frenzy and social stuff on what could happen. But as you said, we know this at the moment, so it's unlikely it's going to change that much, and we need to do something about it now rather than leave it. So yeah, so it's all very interesting, very good.
Yeah, and I
With
think I think on that, Phil, just sorry, I guess the I think there are. You say it's interesting. It's extremely interesting. I think, it's a massive headache for advisors. And I think speaking to a lot of advisors November, December last year, it was kind of a WTF moment. Kind of, what do we do now? How do we change everything? Some clients were going to have to go back over 20 years of advice, etc., and revisit everything we've done and look at things. Whereas now I think, advisors are getting their heads around, okay, right, step by step, this is what we can do and what we should do. And I think, certainly around the whole BR piece, I think, key considerations that advisors need to be looking at right now are the wills. Check out the wills that clients have. Are they joint tenants or are they tenants in common? What does that mean for their BR allowance, if BR is appropriate? Excuse me. Consider as part of that, get under the skin of unused pension pots, understand what is there. Just it's a great time for there will be some clients who have never put their workplace pension in front of their personal financial advisor, etc. And now is the time where advisors need to be collating that information. So annual reviews, now is the time to be getting that information out of clients. It might be, well, you've always just let that run for the last 10 years or so. Now we need to understand fully what it means and where it sits. Equally, if clients are directors of their own businesses, it's really important now for IFAs to get under the skin of, okay, is that company business relief qualifying? What does that mean? Equally, if it's not business relief qualifying, is that because it's got excess cash? You need to do some planning around that. And there's corporate BR propositions out there, which again, speak to Phil or your local Deep's representative about Deep's Protect, which can help you out there. And also, if you are looking to sell down other assets, or whether it be AIM assets, which you've made a profit on, which would be lovely. But if you are crystallizing a capital gain in order to do some of this moving around of assets, then EIS has to be front and center of what you're thinking about, because EIS not only has income tax relief at 30%, it's not only BR qualifying, but you can also defer a CGT liability, and all growth on that is tax-free as well. So EIS, if you've never looked at it before, etc., needs to be part of this consideration as well, so you can wash through some of those capital gains that will hopefully be there, because your advice has been so good historically. And then I think the other thing is, the whole thing around, transferring from AIM to non-AIM assets. Consider the timing of that. Look at kind of where the valuation sits. Is the client, going to be out of pocket, or is it an acceptable loss? And is it the right thing to move everything now for future planning? And also the key thing about replacement relief, like I said earlier, up until the 5th of April, our understanding is that replacement relief on AIM to non-AIM is at the full amount. So currently those will benefit from 0% IHT, and with replacement relief moving into a non-AIM product from day one, they will qualify for 0% IHT. However, from the 6th of April, transferring from AIM to non-AIM, the 2-year window will come in at a 20% IHT level, which matches the AIM. So again, if you are concerned about health, etc., or age of a client, and you are moving them, then you really want to get that done before the 5th of April, so that you've got that 100% IHT mitigation.
Brilliant. Yeah, and I think again we've seen quite a lot of inquiries about EIS and people selling businesses off and CGT and so on and so on. So I think the key here is, I've just noticed we're up for time, but I think the key message from today is there are options. Don't sit on it until the last minute. Apathy is not going to sort this thing out. Even for myself, I mean, I've got stuff I need to do now, and I need to make a will. You just mention that, just been putting it off and putting it off. So let's get it all done. Thanks for your input today, Andy. It's been really useful. Next Wednesday we're on again at 9:30. So we've got another guest on for there. So in the meantime, if you've got any questions or you need anything from head office, please contact your local BDM, and we'll look forward to seeing you again next week. Thank you for your time today. It's much appreciated. I know everybody's busy, and we'll look forward to speaking again next Wednesday. Have a good day. Thank you.
Thanks, Phil. Thanks, everyone.